With more than 6,000 small and micro-cap companies listed, if you're looking for the next Apple at the earliest stage, then ChannelChek truly is the orchard. The listed companies support ChannelChek, so it's free for you, the potential investor, to gain access to institutional quality research from FINRA licensed analysts, advanced market data, industry reports, news, and a growing catalog of videos and webcasts. Make sure to subscribe to our YouTube channel and register for ChannelChek so you're always up to date on what's going on at the small and microcap data place. Welcome to the virtual Roadshow series presented by ChannelChek. This Roadshow features Darren Jamison, President and CEO of Capstone Turbine Corporation, NASDAQ ticker symbol CPST. Following a formal presentation, Darren is joined by Michael Heim, Senior Research Analyst for Noble Capital Markets, a FINRA-licensed SEC-registered broker-dealer, for a Q&A session featuring questions that were submitted by the live audience. You can find Michael's research on Capstone Turbine on channelchek.com or by clicking the link in the description. With that, I'm pleased to present Darren Jamison.
Thank you. Good afternoon, everybody. Darren Jamison, CEO of Capstone. The presentation I'm using today is found on our website under Investor Relations, so please go ahead and look for it there as well. Really what we want to talk about today is the changing energy market. A lot has gone on in the energy space, and what you're going to see in the next several years is going to be an acceleration of what's been happening. I like a quote from John F. Kennedy here that I use in this slide saying, "Change is the law of life, and those who only look at the past and the present are certain to miss the future." And the future of energy is going to change quite a bit and is changing quite a bit. Obviously, the new U.S. president, Mr. Biden, re-entered the Paris Climate Accord. But you're talking about, China, who's now looking at carbon reduction. You see it in Latin America. You see it obviously in Europe, has been a leader for climate change. You're seeing it in Canada. You're seeing it in Mexico. Really across the board, I think everybody's looking at climate change. If you think about today's population, 30 to 40% of the globe has grown up with climate change, and so they're very in tune to it. And I think COVID-19 only highlighted man's impact on the planet. And so if you think about here in California, we saw much clearer skies, much less smog. Fewer cars on the road, people working from home. We saw the real impact that man has on the planet. We saw wildlife come back to our mountains and our parks. You see in Venice, one of the pictures I show on this slide of the canals being clear. So definitely there's impact on the positive side of COVID. Also on the negative side of man's impact on the planet, you see climate change leading to more forest fires, larger storms, flooding, the ice storm we just had in Texas. So there's lots of global impact that man has on the planet. So why is that important? It's important because consumers are now thinking about sustainability and climate change. And if consumers are going to start voting with their dollars, then companies have to react to it. And so depending on what study you look at, but about 2/3 of consumers, and they're making a purchase decision, are thinking about sustainability when they look at brands and which one to select. 70% say that that's definitely a consideration of what they're buying, and about half today are saying they're willing to pay more for sustainable product. I'd argue all these are going to move to higher levels of sustainability and caring as we go forward. And so that kind of underlines the whole reason that Capstone is around, to help customers lower their carbon footprint, but at the same time save money. So in the last 2 years, we've saved our customers 718,000 tons of carbon. Which is not bad for a fairly small company, about $500 million in their financial savings. This year, I'm sure we'll announce our latest savings, and it'll push us over 1 million tons of carbon and probably about $750 million in savings. So we look for customers who are energy intensive, that use a lot of electrical energy as well as thermal energy, because we can give them the best carbon savings and the best financial savings. What you see pictured here on our cover is one of our biggest installations. This is a 5 megawatt CHP installation at Mohawk Carpet and Tile. It's about 30 miles outside of Nashville in Tennessee. In this case, we're taking the thermal energy off the microturbines that are making electricity and putting it into a single exhaust header, as you see in this picture, and we're actually curing the tile. So we're actually like a kiln. So we're making the tile part of the process of using the microturbines with the thermal energy coming off them. Microturbines are a little different technology than wind and solar. We give electricity plus thermal energy. We can convert many different types of fuels into thermal energy. So think of us as kind of an energy conversion device that makes electricity and thermal energy. In this case, the thermal energy is basically used as steam or direct drying application. But again, we're looking for customers, hotels, office buildings, industrial manufacturers, folks that are using heating, cooling, chilled water, hot water, the like. So if you look at our efficiencies, we're very similar to fuel cells or higher. Typically, we see about 85% or more efficiency when we take the thermal energy off the machine. Fuel cells are in the 50 to 60 range. Fuel cells are electric only. We're electric and thermal. So fuel cells are better for customers that don't need a lot of thermal energy, box stores, folks like that may have very light heating or cooling loads. We're better for industrial customers, hospitals, high-rise office buildings, people that need a lot of hot water, a lot of steam. And that's part of the challenge with wind and solar and even fuel cells is they don't give you a lot of thermal energy, and so it doesn't really replace boilers and chillers, which are a big part of the emissions profile in our country and around the world. So 85%, we can get to 95% on certain grades of steam, and then we also do direct drawing as well. So fuel in, electricity out, and then thermal energy out the top of the machine. So the benefits of our microturbine products, I think what's important is our microturbines are just part of a solution. If you look at most of our CHP installations or combined heat and power, they're being sold with battery storage in many cases, with solar panels in many cases. If you look at Sierra Nevada, one of our good customers, they've got about 2 megawatts of solar, 2 megawatts of CHP microturbines, and 1 megawatt of Tesla batteries. I think that's kind of the new model we're seeing customers go to is there's no single clean energy solution. It's more of a shotgun approach and taking multiple clean energy devices and having them work in concert together. But our microturbine itself, very low emissions, very similar to fuel cells in our emission profile, just much cheaper. Patented air bearing technology. This is one of our 112 patents that we have. What's key about that is that we have no lube oil, no grease, no antifreeze. We have one moving part. It gives us very predictable maintenance and very long time between maintenance and makes a very reliable product, which is key to us. Because folks don't want to be in the power plant business. They just want to save carbon and they want to save money. They don't want to spend a lot of time changing oil and working on a power plant. We are inverter based like wind and solar. Unlike wind and solar, we have onboard batteries, so we can actually do backup power as well as prime power. So we typically run prime power 24/7, 365, but if the utility were to go away, we can pick up critical loads and keep running. A lot of people don't realize if your utility goes away, your wind and solar are no longer generating energy. Fuel availability, we'll talk more about this, but traditionally we've been a natural gas solution, but that's evolving as well. We're doing a lot of renewable natural gas, a lot of biogas, cow manure, chicken manure, pig manure, green waste energy. There's a lot of movement toward putting biogas into the natural gas infrastructure for renewable natural gas. We also do hydrogen as a new fuel for us, so we're actually blending hydrogen with natural gas, and we've got a path for a 100% hydrogen product. So our goal really is to, if the customer is going to operate on diesel or kerosene or biodiesel, that's great. If they want to do natural gas, propane, butane, ethane, that's great. We do still do a lot in the oil and gas industry as we kind of green up oil fields or decarbonize oil fields. In that case, we're taking the associated gas you get when you drill for oil, casing gas, seam gas, they call it, put that into our microturbine as well. So we're very fuel agnostic, and we want to take as many fuels as possible and provide the most clean and efficient power, and again, save customers money and reduce carbon. Pre-clean waste heat, again, we're different than other technologies because we do generate that heat and allows us to off-put that heat and basically get customers to turn off their boilers and their chillers and reduce those emissions. All of our machines are set up to be remotely monitored, which is very, very important. We've built over the last 10 years a global distribution channel. So we've got distributors covering currently about 73 countries, about 65 distributors. And this allows us to really expand the business into larger rollouts with bigger customers, knowing that they're going to be safe no matter where they put the product. There's going to be a local support and local monitoring of those systems. So the systems can be remotely monitored. We can download software. We can do diagnostics. We can do some level of maintenance and software changes remotely. And it's very important that we can know what's going on with machines. Then scalable. Almost all of our machines are multiple machines, and so we like to sell them in kind of 3 to 10 to 15 units at a time. For us, we think that's better. It gives the customer more flexibility, gives them higher reliability, and just lets them load follow electrically or thermally, and just gives them more backup, right? So if one machine is down for maintenance, they don't lose the entire plant. If you've got a fuel cell and the fuel cell's down because the cell stack's got an issue, if you got an internal combustion engine, you've got to change the spark plugs or change the oil, you lose 100% of your output. And so our goal is to make it to where the customers always have 90+% of their output. So catalyst for growth. COVID year was actually a very good year for us. We hit a lot of our goals that we had going into the year and managed to continue to hit those goals despite COVID. Obviously, revenue growth has been the biggest challenge during COVID, and we're really focused on growing revenue this new fiscal year. We're a March year end, and so we'll be announcing the Q4 results here shortly. But our goal for the next couple of years is top line revenue growth. And so obviously the new Paris Climate Accord with the Biden administration, the infrastructure bill they're working on should be positive for us. Continued low cost natural gas is great. I mentioned Sierra Nevada microgrid adoption, people that are put in maybe solar or put in some battery storage, but they're not getting the output and the results they're really looking for. We want to pair our machine with those and give them the kind of results they're looking for. Really, people focus on reducing costs. I know being green is great, but I like to say making 2 shades of green is important. We want customers to get a 5-year payback or get the economic return they're looking for. I think everybody wants to be sustainable, they want to be green, but to really go all in and to really take control of their energy future, that needs to be cost effective for them. It needs to save them money and make them more competitive in what is a global economy. New engine emissions, we're seeing here in California, they're trying to get rid of internal combustion engines in cars. You saw Volkswagen cheat on emissions a few years ago. All these changes in emissions, all these reductions and target dates are all great for us. And so we can meet emissions anywhere in the world. We're CARB certified here in California. We've never been turned down for an air permit. And so we're 1/10 the emissions of an internal combustion engine. And again, similar to fuel cells. So we welcome and applaud lower and tighter emission standards. And so as the world moves toward those, it's going to make us more competitive and grow our operations. Green building. If you're in New York, you probably know One Vanderbilt right next to Grand Central Station. That's got 1.2 megawatts of Capstone product. The 2 towers in Hudson Yards have our product. We've got a lot of the FMC Tower in Philadelphia. A lot of the newer architects and engineers are looking for the highest levels of green building or LEED certification. And so it's more of those architects and engineers and end-use customers demand LEED. It really moves us on toward those areas. And to get the highest levels of platinum LEED, you need on-site generation. So we're a great solution. If you look at severe weather, unfortunately, what happened recently in Texas is driving opportunities for us. What happened in New York with Sandy drove a lot of opportunities and a lot of the great marquee installations we have today. The California wildfires are helping us here in California. So as people lose electricity for an extended period of time, they realize how fragile the utility grid is. It's opening up opportunities for us and our distributors and our direct sales team. Electrification. We've got a project going on in Mali right now. We've got stuff going on in India, China, parts of the world where there is no grid or a very unreliable grid. And so as more people need clean water and clean electricity in these remote locations, it's definitely going to help us. Our product works well in all kinds of remote applications, and whether it's North Pole, South Pole, Siberia, the deserts, it doesn't really matter. The machine is very, very reliable in multiple locations. Gas flaring regulations, I mentioned oil and gas. I think you're going to see more and more restrictions on flaring associated gas, and the oil companies are really pushing to be more ESG compliant. Before COVID, I was at a Goldman Sachs seminar with energy companies, and I think 12 out of the 13 CEOs talked about ESG and decarbonizing the oil patch, and these are the big majors. And so I think they get it, that they need to be better players and lower their impact on the planet, and we're there to help them do that. So that's exciting for us as well. So again, we're a clean energy company, but oil and gas is about 1/3 of our business today and will continue to grow. And then crude oil prices, that's the only thing on this chart that's not green from kind of a catalyst standpoint, but I'd say it's yellow. Oil prices have been over $50 a barrel for several months now, and if it stays there and continues to stabilize, we're going to see more money spent in the oil patch, and obviously that's good for us. And again, we can help them lower their carbon footprint as well as lower their cost, because why should they buy electricity from the local grid if they can generate their own using gas that's basically they're flaring, which is essentially free? And if they flare it, they add to global warming and are going the wrong way as far as ESG and their carbon footprint. If they capture that gas, run it in a microturbine and destroy it, then they're heading the right way and saving themselves some money. So growth strategy, I said, is really key. We kind of have a 6-pronged attack for revenue growth. Before COVID started, we put together a new direct sales team, kind of a solution sales team. Their goal is to take some of the wins our distributors have had over the years that may be one-off projects and look for larger scale rollouts. So going after, Mohawk Carpet and Tile, it's great. We have the 1 installation. How do we go do 10? Pepsi, Marriott, Honda, anybody who's worked with the product before, understands the product, maybe he's done an installation or 2. This group is really tasked to go out there and turn that into larger scale rollouts. Timing is everything. I think that we're at the right place in the green energy kind of movement that I think a lot of the bigger companies are looking for ESG and carbon footprint reduction. And then we're at a place where our balance sheet is sound. And I think we're in good footing to go ahead and sell directly to these folks and build those relationships where we couldn't have done that in the past when we had a weak balance sheet and an unprofitable business. New geographies, our last couple of press releases were Middle East and Eastern Europe. We're definitely focused on expanding our reach into non-traditional areas because energy and clean energy is a global issue, not just a US and Europe issue. New digital marketing. We really updated our website a lot, and we've got some more changes coming in the next few months, so keep coming back and checking on it. But we've really customized our campaigns. We've really leveraged our social media. We've got an IndyCar sponsorship that we're doing a lot with, and as far as kind of a brand ambassador and really helping raise awareness of green energy, and that's opening up more opportunities for us as well. And then target pricing, as we look at these bigger rollouts, we're going to come up with more creative pricing and financing solutions for those customers to get them to really make a big commitment and write a big check. Obviously, hydrogen is very much of interest. Since we announced our hydrogen blend program and working toward 100% hydrogen, we've got a lot of inquiries in. We've shipped our first commercial products, but we're seeing more and more interest every day. I think more people are realizing hydrogen is the future, and the future may be closer than people realize. And then last one here is improved customer satisfaction. Unfortunately, we had a vendor a few years ago who looked to make some cost savings on our part that they were contract manufacturing for us, 20-year relationship, and they went to save some money, and it really impacted the product. And so we went from a 3 or 4% failure rate to over 30%. We've remedied that, and we're in process of getting all the rest of those parts out of the field, and we'll do that the next couple of quarters. What's important is we're improving our customer satisfaction and customer experience. We also got a $5 million settlement to help us fund removing those parts from the field. So very excited to kind of get those ankle weights off. So with customer satisfaction increasing, COVID decreasing, the new direct sales team out there, the new digital marketing campaigns, and the new hydrogen product, we're excited about the next couple of years from a growth standpoint, that we could see some really big top line growth numbers. I'm not going to spend a lot of time on financial results because, as I said, we're March year end, so these numbers are kind of dated. I think what's important in this slide is that, through December quarter, we're up 39% quarter over quarter, 19% year over year. And really the shape of this chart, the fact that obviously we got hit like everybody did in COVID, that first quarter, but we've been fighting our way back, and you're seeing, revenue growth return, and that's what we need. We need to be a $300 or $400 million business as quickly as possible. So I'm gonna skip through some of those slides again. These are on our website. I think I want to spend a couple minutes talking about our energy as a service business model, because I think this is one that shareholders really don't understand or don't value enough. And so when we sell products, our margins are fairly low because we're a low volume manufacturer and it's a high tech product. Our product margins will increase as our volumes increase. In fact, if you look at our social media, we show recently a C200 that we built in a single day. And so it doesn't take a lot of labor to build our machines. And the reality is we got a shop that's 20 to 30% of capacity. And so as we fill the shop up and we lean into that capacity, you'll see product margins improve. But in the meantime, our service margins are really what carries the business. And so our goal is to get those service margins up to about 50%, 50. That's a blended overall margin. And that's our spare parts. That's our long-term service contracts. We call them factory protection plan. That's our new long-term rentals fleet, which we just announced recently. We expanded it from 8.6 megawatts to 10.6 megawatts. Our goal is to get that to 20 megawatts, and that's funded by Goldman Sachs as part of our relationship with Goldman Sachs. And then our distributor support, call it a subscription agreement, I call it. We charge our distributors 3% of their prior year's revenue every year. And so that kind of fee comes back as 100% margin to us, but we really take that money, and that's how we support, the IndyCar work that we do, a lot of the marketing work we do, branding work that we do, as well as their Salesforce licenses and seats and training and all those promotional materials, web development, all the good things, and customer acquisition that we help them with. And so it's almost like a franchise fee that we help them grow their business, which helps us, but allows us, frankly, to play at a bigger level against our bigger competition that are, more funded from a marketing and branding standpoint than we are. So very, very excited about that. That obviously, that fund will grow as the business grows, but you can see the impact of that vendor quality issue that I mentioned before. we were well on our way toward that 50% margin target, and then we took a step back for a couple of years as we had to remediate that situation. But we're very confident we're going to get back to that 50%, and that really leads us to what I call absorption. So we get to the point that we're doing 10-11 million dollars a quarter in aftermarket revenue at a 50% margin. That's going to cover our entire OpEx. And so unlike many people in the clean energy space who are losing money every quarter, aren't adjusted EBITDA positive, cash flow is terrible, we're going to get to the point where we're cash flowing every quarter and that we're positive from operations every quarter. And so that's a great foundation from which to build higher revenues and build the business, and stop diluting your shareholders, as obviously I'm a big shareholder myself and I care about that. I'll talk about hydrogen real quick, and then we'll open up for some Q&A. As I mentioned before, we've been working on a hydrogen product for several years. We're taking orders now for 20% hydrogen. We've got 10% hydrogen blend in the field commercially. Our goal is to be probably 30% by the end of the year, and then at the same time, parallel path, we're working on a 100% hydrogen product. And so we've patented a hydrogen injector. We're about to start testing that injector at the U.S. Department of Energy in Illinois, and as far as their national lab there. Currently, we're running our standard injector at that lab at a 70% hydrogen, 30% natural gas mix. And so we're still learning what our system can and can't do. But there will be a fairly major redesign for the 100% hydrogen product, so it's a little further away. But we're pretty excited about having a hydrogen blend solution near term and to get a lot of customers started on their hydrogen journey. It's also interesting because you got wind, you got solar, you got biogas and hydro. Those are intermittent power. They're not 100% base loadable power like us. So they generate excess power. And so the goal is to take some of that excess power, put it in an electrolyzer and create green hydrogen. And so there's lots of different ways to make hydrogen, but green hydrogen, I think, is what the globe economy is looking for, what people want to see happen. And so you can take that green hydrogen, you can store it, and then you can put it in the natural gas pipeline. Then we can run that in our machine. And so the goal is to base load thermal and electric loads using green hydrogen. So with that, let me open it up to Q&A, because I know we're about 23 minutes into the presentation.
Okay, thank you, Darren. My name is Mike Heim. I'm the senior analyst for Noble following Capstone Energy, and we've got a handful of questions that have been sent in. I'm going to start out with one of my own and get a little topical here. We've got a new proposal by the president, the American Jobs Plan and Infrastructure Proposal, a $2.2 trillion proposal, of which about $100 billion of that is for energy infrastructure. Help us think about how we should think about this and how it could have an impact on your company. Obviously, it's very eco-friendly, which is good, but on the other hand, it's subsidizing and improving the reliability of the electric utilities, really one of your competitors.
Yeah, I mean, the electric utility is a competitor, but the answer is, green energy is good for all of us, and I think a lot of the utilities are realizing they need more green energy, and their infrastructure is definitely needing to be upgraded to allow more green energy on the grid. We see it in Europe as well, where too much green energy is actually creating problems. The utilities actually like us because we're inverter based and we're 24/7, 365. We don't come and go as a cloud goes overhead or the wind stops blowing. So we're very utility friendly, shall I say, even though we are technically a competitor. But I think you're going to see a lot of green building initiatives, a lot of people adding more infrastructure. We're seeing utilities interested in our technology and putting in microgrids and helping customers that are at the end of the line or in areas where they're constrained. And so I think all of this is moving the right direction. And again, we don't see utilities as a huge competitor in a lot of ways, because for customers that need thermal energy, you can't get that from your local utility, right? You can get electricity out of your wall socket, you can't get hot water, steam, and chilled water. And so I think there's a solution that we provide that really accents the utility. We don't recommend people totally disconnect from the utility, though a lot of customers are angry and want to do that. We recommend that you blend our product with the utility and optimize the solution.
Are you hearing any talks in any of the proposals that would directly affect your company, subsidize for customers, that type of thing?
Yeah, definitely. I think there's energy efficiency subsidies at both the state level and a federal level. There's green building initiatives, I think, that will happen. And I think as you rebuild infrastructure, they're going to want to do it in a green way, which is going to lead folks to our technology. And so I think all of that's going to be positive for us. I think, again, any kind of regulations on flaring or emission reduction is going to be helpful. And so I think all of this is good and it's all moving the right way. And I think with a lot of technologies, having the right technology is great, but you have to have the right market and the right time. And I think it feels like now is the right time to be a green energy company.
You ended your proposal talking about what your work with hydrogen, and we've got several questions coming in talking about electric vehicles. To this point, you've kind of talked about hydrogen more as use in terms of on-site generation, but what role could it have with electric vehicles?
Yeah, definitely. I mean, hydrogen can play a role in many places. I think it can be part of traditional power generation. It can play a role in distributed power generation. It can be involved in charging stations. I think one of the challenges people have is if everybody had an electric vehicle, we wouldn't have the infrastructure to support it. And so there's a huge amount of infrastructure that needs to go in. If you look at how many gas stations are around the world versus electric charging stations, the grid is not going to be able to support all these electric vehicles charging at the same time. And so I think you're going to have distributed generation solutions and distributed generation charging stations. And so, we can charge batteries at a charging station using natural gas, using, hydrogen, using propane, butane, diesel, whatever we need to, whatever makes the most sense. And so we can do it, cheap, we can do it economically, we can do it quietly. All these things are important. And so I think that, again, all the rising tide kind of lifts all boats. I think you're going to need a lot of different solutions with some of these hefty goals people have. But I think the more you see electric vehicles and the more you're going to need more charging stations, the more infrastructure the utilities are going to need. And the utilities need to come up with more dispatchable power and more, easier ways to kind of meet the changing architecture.
Is there a role for microturbines directly in the vehicle?
We actually were founded on a hybrid vehicle solution, and actually I've got a Kenworth truck out back with a microturbine in it. There definitely is a role there. I think, the issue is cost. We've got to get our volumes up and our costs down, and we work as a range extender. And again, that's what the company is founded on. We've done a lot of buses, a lot of trucks. We work better in a work vehicle. And so if you're going to run 1 million or 2 million miles, then our microturbine makes a lot of sense. For a small vehicle, passenger car, it doesn't make a lot of sense because the price of the microturbine is too high and it's too industrial. I mean, we'll go 2 million miles in vehicle equivalent. Nobody drives their car for 2 million miles, and so you'd be throwing away a microturbine that's not used up yet. But for buses, for industrial, work vehicles, we've got some of our first marine products running right now. I think there's definitely workboat applications, electric workboats make sense. LNG tankers, we've got a couple tankers, we've got microturbines on board. So, finding the applicability is not the challenge, it's more of economics. So how do we make a microturbine make financial benefit for the customers? Because a lot of our vehicle work we've done has been more demonstration or it's been funded, right? And so we want to find solutions that don't need to be funded by the government, that consumers just purchase and customers purchase straight out.
You mentioned the government. We did have a question talking about if you do any sales directly to the government, or is that something that might happen in the future?
We do some direct sales to the government. Most of our sales to the government are actually through ESCOs, like Ameresco. They do a lot of shared savings programs with the government, but we definitely will sell directly or through partners that are working hand in hand with the government. We've got multiple installations, again, mostly facilities that are government-owned facilities or bases, or not a lot of military work. Unfortunately, the kind of enemy to microturbines is high dust environments and high heat environments. And so our U.S. military likes to go to dusty, hot places, so that hasn't been a great fit for us. But for bases or for embassies or for government installations, absolutely, we're a great solution.
Okay. You talked about the importance of profitability and positive EBITDA, and there's a question coming in. Just says, any updates on the adjusted EBITDA year-over-year improvement tracker that you introduced in the first quarter presentation?
That's a great question. Yeah, so for those that don't know, we came out with COVID and said, okay, we don't know what revenue is going to be for the year, so we had trouble giving folks a revenue goal. But we said, look, we think we could improve our EBITDA about $10 million year over year. And so what that said is last year we're about $13.5 million in adjusted EBITDA loss, and so we thought it would be around $3.5 million adjusted EBITDA loss this year. We were EBITDA positive in the first quarter. We're cash flow positive the second quarter. We kind of stopped showing the tracker after Q3 because otherwise it would have been really, when you're only forecasting one quarter, it's kind of you're kind of giving the answer away. So we will bring it back here when we announce the fourth quarter. But we're definitely in the ballpark. I won't say whether we made it or not, but I said, we definitely got close to the 10 million goal. And I'm very proud, frankly, of the team and how we performed this year. our improvement on an EBITDA basis year over year, despite COVID, is remarkable. And the fact that we're teed up really for revenue growth for the next couple of years. We're developing hydrogen. We've kept all of our employees safe. We haven't shut down one single day. And so we've really done, a remarkable job. The team has, to keep everybody safe and keep moving forward and keep, delivering, our goals and our plans and our visions.
How do you weigh that trade-off between near-term profitability and longer-term growth?
Boy, I wish I had an easy answer for that. That is our biggest question for our board of directors, and we ask it all the time, because I can get profitable tomorrow, but I'm going to be sacrificing hydrogen and be sacrificing growth and the direct sales team. And so you saw that in the first quarter where we were EBITDA positive, but that was, really, getting rid of our entire R&D group, furloughing them. I mean, so it was really sacrificing the future. And so I think there's a balance. If we can get to the point where we're kind of cash flow neutral, but we're driving long-term revenue growth and developing future products that are game changers, that's where we want to be. I think if I look at a lot of the fuel cell companies and they have raised hundreds of millions of dollars or close to $1 billion in the last year, and just horrible dilution, and they're spending money like drunken sailors. And I just think, you take profit to the bank, not revenue, but I think revenue growth is important and really market adoption. And so I'll skinny up my margins if I can go to a customer who's going to help me get market adoption versus a one-off sale. And I think for us, we've got to value what we spend our money on and what the future benefits are going to be of those dollars we spend.
Got a question in here, wants to talk about the sales force adjustments that you made over the last couple of years, or really last year. Let me get to the question directly. How will the new direct sales team change your sales mix, and how is the new parts manufacturer changing your EBITDA margins going forward?
No, two very good questions. The direct sales team we had goals of about 15% of our top line revenue from the direct sales team this year. We're very close to hitting those goals. Again, this is a team we put together starting in January and through most of the summer. I've not met one of the direct sales folks in person. None of them have been in the factory. So it is a COVID sales team, shall we say, Zoom team. But as we continue to build that team out, we'll take it from about 5 or 6 employees today to 10, 11 the next fiscal year. And they've generated a pretty good pipeline of opportunities. And again, a lot of that is because they're taking opportunities that have been started by the distributors and then leveraging that. But we expect them to see some significant growth. They should probably double their revenue growth next year over this year, and probably double it again or more the following year. They're building a pretty robust pipeline. And again, it's a little apples and oranges, because the direct sales team is taking a customer who already has the technology at one location or 2 locations and looking for a large scale rollout. And so it's kind of an easier lift than trying to get the very first order. We are still working hand in glove with our distributors. They are our partners. They're our boots on the ground. If you look at a lot of the direct sales works we're doing, the distributors are right there at the table with us. In fact, it's important for the customer to know that once we sell this, we're not walking away. Our distributor's there to make sure the installation goes well, the commissioning goes well, the after service goes well. We'll sign service contracts up to 20 years. All that work's done by our distributors. We don't have trucks, tools, direct service team, and so all that work is done by the distributors. And so it's important that they're involved in that rollout. So I think that's big, but we'll continue to grow that. Again, I see this as just a maturation, the next phase of our development. And I think to get larger customers, we need to interface them at a CEO level.
You touched briefly on the California blackouts. I don't think you mentioned the Texas blackouts, but we do have a question that came in that says, during the recent Texas blackouts, oil wells failed to produce associated natural gas due to rolling blackouts from utilities. And this caused gas-fired generation plants to shut down. Are your turbines a potential solution to this energy independence issue? And how can you deploy your sales force to address this potential market?
Yeah, definitely. We're a more robust solution than a lot of the other ones. The issue really is understanding where those failures occurred and why they had to shut down. If they shut the well in, then obviously if we don't get fuel to our machine's not going to run either. But I think you have to look at each application. In general, though, I would say the amount of inquiries we've gotten since that ice storm that they had and the utility failures they had has definitely gone up substantially. Mostly though from end use customers who are looking for ways to have power when the power goes out. All of our machines continued to run that we had in Texas that had fuel. And most of them did have fuel, so that was great. And I think for the most part, anytime there's a natural disaster or some reason that there's a utility blackout, it creates opportunities for us. And so whether it's wildfires in California, hurricanes, or the Caribbean's turning into a really nice market for us, because in that case we can run on propane, and we've had really good performance during the recent storm seasons of our machines continuing to run for high-end hotels and office buildings. And so I think that the more people realize that electric utility is not a guarantee and that it can go away, especially at the worst possible times, it's going to generate more opportunities for us. And that's why we need to do more outreach, both digitally and with our direct sales organization, and more education. I mean, our biggest challenge is, frankly, we're kind of the only microturbine manufacturer out there. A lot of people understand the value and the features and benefits we have. And so the more we can get our name out there, the more branding we can do, the more marketing, and the more customer education, the more sales opportunities we're going to get.
We haven't spent much time talking about your balance sheet, but you've kind of improved your liquidity a little bit here. Some of that, I think, was associated with the uncertainties with COVID, but how do you view things now as we get past kind of some of the COVID concerns?
No, absolutely. I mean, our balance sheet's important for multiple reasons. I mean, one, we got to make sure that we've got a stable company. Two, we got to make sure when we go try to sell to a large, end user, that they're comfortable with us being around. Us signing a 20-year, factory protection plan is only as valuable as our balance sheet to be around to take care of the customers. And so our balance sheet has always been an issue, and improving it's been a major goal. I think COVID just kind of added a heightened sense of urgency. When COVID hit last, March 31st, we had $15.2 million in cash, $9 million restricted. And so, we had about $6 million of free cash facing a global pandemic. Not a great feeling. And so we really focused over the last year to improve that. We announced last quarter, the December quarter, we're up to $32 million in cash from that 15.2. And then since then, we publicly announced about $14.5 million of financing, along with a $5 million settlement, legal settlement. And so that puts us pretty close to $50 million, which is not a bad place to be. And so we'd like to see the balance sheet north of $50 million in cash. And that gives us the comfort moving forward that we can, safely invest and handle working capital swings or accelerate the hydrogen program if the market moves quicker than we think it's going to. And more importantly, make customers and vendors and employees and distributors and investors all, know that we're going to be around tomorrow and for a long time.
Is there one part of your story that you feel like investors don't understand as much as they should?
I think definitely it's our energy as a service business is the part of the story. I mean, to me, reoccurring revenue should be 4 or 5x, traditional revenue. And the fact that we have a very profitable reoccurring revenue stream, that half our business is reoccurring. The fact that the first quarter of COVID, we were adjusted EBITDA positive because product revenue isn't that important to our bottom line. And so product revenue fell off the table, our reoccurring revenue hung in there, and we still saw good results. And so I think building these long-term annuity, high-margin revenue streams is very key. I think one of the questions I didn't answer that you brought up was the remanufacturing a product. That's probably the second area that people don't understand. Today, most of my cost of goods in my service contracts are new parts that I buy or manufacture. And so as we move forward and the fleet gets bigger, we get a bigger rotable pool of used parts. And as those used parts come back, I've got now 2 remanufacturing centers. As the stream of parts picks up, the amount of remanufactured parts going into my cost of goods and my service contracts is going up. And so I can remanufacture a part typically about 40% cheaper than new. And so as the used parts stream, flow increases and our remanufacturing centers output increases, that's 40% cost savings for our service contracts. And so our target is 50% on the service contracts, but if I look down the road, that's fairly conservative. We could be well past 50% in the out years.
Darren, I think that's about all the time we have for today. I appreciate you coming on and telling us your story and helping us all understand it a little bit better. If anyone would like to get copies of our independent research I've written on Capstone Turbines, go to channelchek.com. Again, thank you, Darren Jamison, for joining us and telling us about Capstone Turbine.
Excellent. Thank you, Michael. Stay safe.
Thank you for joining us for this virtual roadshow presentation brought to you by ChannelChek. View our YouTube channel for more video content, including C-suite interviews, virtual roadshows, and conference presentation replays. New content is added regularly, so subscribe below to stay up to date. Visit channelchek.com or click the link in the description to access equity research, news, and advanced market data on this and 6,000 other small and microcap companies.